Howard gets here.
Recording in progress.
Okay, I'm calling to order the Police and Fire Retirement Board meeting. And we'll start off with a roll call. Sunita?
I present.
Andrew?
Here.
David?
Here.
Howard Lee is not present. We have seen Eswar. I think he just stepped out for a second.
Yeah.
Dick?
Yep.
Dave Wilson?
Here.
And I, Frank Lovato, am here. So for orders of the day, we have none. We do have some items to waive sunshine on. We have item 4D1, 4D2, 4F1, 4F2, 4F3, 4F4, and 4F5.
So moved.
I got a motion from Dick. Do I have a second?
Second.
A second from Dave Wilson. All those in favor? Aye. Opposed? Okay. All right. Our next item is, oh, and for the record, Howard's here. And yeah, as War's in here too as well. Our next item is closed session.
There are two closed session items. Which one are you going, are you going in order?
Yes.
Okay.
Recording
So
Recording in progress.
we'll reconvene from our closed session. Maytag?
So for closed session, IA 1A, it's for 15
Okay, I do have one item to report out from closed session. Let me see. Language. regards to item 1A, which is performance evaluation related to an investigation. The findings in the report were accepted by the board. The allegations against our counsel were unfounded. We are re-engaging counsel to advise the board until we receive the final report, and there is no conflict of interest.
And there's no reportable action for item 1B closed session.
Thank you. Okay, I believe our next item is the consent calendar. And a motion from Wilson, second from Dick. All those in favor?
Aye.
Aye. Opposed? Okay. Moving on to item number 2, investments.
All right, good morning, trustees. Thank you, Mr. Chairman. We have a fairly long investment session because we have performance. And if someone can just bring the agenda back. I think we have performance, we have a discussion on capital market assumptions, and then we have pre-funding. And on capital market assumptions, we had a very detailed discussion at the IC, but because today's board meeting was going to be very long, we decided to do this in 2 parts. And today for 2F, Makita will discuss capital market assumptions. And then at next month's board meeting, we will revisit this and talk about strategic asset allocation. With that, I'm going to go back to, I think it's 2A, and turn this over to Casey Boyer.
Prabhu, before I apologize. This is Roberto. I don't know if you or Jay or Mikita is able to provide us with the unaudited numbers for the most recent returns for the plan. I know you do that require. I don't want to put you in the spot. I don't know if that's available or not.
It is available, Roberto, and thanks for reminding me. And it was shared by Jared Pratt. And I'm going to pull up his email. I believe it was 6.5%. It was 6.58% as of 2 days ago for the pension plan, and for the healthcare system, it was 6.45%. Again, these are estimates as of March 5th. These are unaudited numbers. And these are, as of some random date, which is 3/5. But at least you have a sense for, what the plan has done fiscal year to date.
Thank you. Thank you.
Of course. With that, I'm going to turn this over to Casey.
Great, thank you. I will share my screen. 1 second. Okay, hopefully everyone can see that well. Always appreciate the opportunity to present to you each quarter. It's very helpful as we're continuing investing and seeing how all the investments are doing on a quarterly basis and monitoring from our perspective. So I'm going to turn everyone to page 2, which I will spend most of the time on. You'll see this looks similar to what you've seen in the past, slightly different. There are 2 middle columns in the middle, which show Neuberger performance. The one on the left is for Series 1, and the one on the right is for Series 2. Series 2 was started in Q3 of 2023. So this is the first time you're seeing this. It is the same exact program. We're making the same types of investments. We're very closely, as always, communicating and discussing every element with your investment team at San Jose. And so when you're looking at this, you can really think of it as the same program, just split into 2 sections. really so that we can analyze performance. When we're looking at the peer universe and benchmarking, typically private equity is benchmarked by investments that take place over a 2 to 3 year period. And so that was part of our thought process in setting up these series, and it would ideally be continued over time, where we would have new series added in an efficient manner for the program. So series 1, you'll see performance. It will look similar to what it was last quarter. There was a net distribution during Q3. So the net distributions went from about 44 million to 46, almost 46 and a half. In addition, post Q3, we also made another distribution of about 2.5 million. So when we look at the numbers for Q4, that distribution amount will go up as well. Net performance, I will dig into a little bit on pages 11 through 13, which will also break out the performance separately of Series 1 and Series 2. So now Series 1 is completely committed. We will not make any new investments. However, there still will be capital drawn down into investments through our primary funds that are still the underlying funds that are still committing capital. So if you kind of see, you'll notice the contributed capital amount that will continue to go up over the next few years, but we will not make any new commitments. The new commitments will now be completed in Series 2. So you'll see here, this started out with $100 million, and typically each year we go through an intensive investment pace analysis and figure out how much we should be committing based on your target allocation and what makes sense to commit for the following year. So far, this program obviously is very early. Only one investment has actually called capital, so you'll see very small amounts here, which will obviously continue to develop with contributed capital over the next years.
Hi, Casey, this is Howard Lee. What is actually in Series 2? What investment? Is that listed somewhere?
Yeah, we can actually see it on, we have a full SOI. It's very small print, so I will, it's actually here on page 14. If you look at the very, very bottom, there was one co-investment that funded, so that's an investment into a specific company.
Oh, okay. Okay, and that was, is it a 100 million commitment? And it was 15, wait.
No, that what this one, so the amount we will commit over the year, like mid 23 through mid 24, is 100 million. We'll commit into a series of primary fund investments, co-investments, and secondaries. That 2.1 million, 2.3 million was only into one co-investment, and we'll continue to make that type of investment, which you'll see in the contribution amounts moving forward.
Okay, all right, thanks.
Yeah, I guess could follow up on what Howard asked. Is the 100 million strategy the same as the 405 million that we have committed? Maybe it's a Dinesh question.
Yeah, it's the same strategy. The 100 million is just based on the pacing plan for the previous fiscal year, which called for 100 million in our current fiscal year ending in June 30th. So the 100 million will be invested in underlying investments, the primary funds, co-investments, and secondaries. So as of Q3, only the 2.3 million of the 100 million had been invested to date, but we've been making investments since that time and getting closer and closer to the 100 million that we expect to over the course of the year.
So what was the rationale in having a Series 2? I'm sorry, or just different vintage? Or?
Yeah, so as Casey said, for the benchmarking, such as on page 11 and 12. So this is based on fund of funds as of 2017. Fund of funds typically have an investment period that can range from 3 to 5 years. So in our case, there's a 6-year investment period for this. It allows for benchmarking. It allows for changes to the underlying legal agreement with this particular investment, so we can make some customizations and changes. And the series structure was actually recommended by our investment legal counsel for this particular program.
Thank you.
Great. Any other questions? Happy to answer on that. But for the most part, if you're just thinking about Q3, which is what we're talking about here, the investments overall in Series 1 performed well. The performance went down very slightly, but that's also because there is new capital going into the ground also, which is always going to be held at cost for a period of time. And so for Q3, everything in the overall private equity markets were pretty much on par with valuations compared to Q2. I would say just in general, deal flow has been up, and we've seen a lot of really great opportunities, some at what we consider good valuations, where in the past things had been marked pretty high. There are still some assets, if they're very top-notch A-plus assets who are that do command a higher valuation, but we also think that's fair given they are good assets. So we do think this is a really great time to be putting capital into the ground. People are needing liquidity and therefore willing to sell assets. So we think going into the next kind of short to midterm will be a really great time to invest in private equity.
Hey,
So
Casey.
I'm going
Casey, sorry, this is Howard again. I may be a broken record. Is there a way that on these charts and also on slide 11, that you can show prior quarter? Because this is just a snapshot of now, or of the quarter that you're presenting. Is there a way we can see how we did compared to the prior quarter on this slide and slide 11?
Yeah, so we do have it on slide 11. You'll notice it on this second line here. You can see exactly how it compares to Q3. And so we definitely could put it on the first slide too, if that would be helpful.
Yeah, if there's some way without making it more cluttered. But yeah, I would like that. Thanks.
Okay, not a problem. So I think this page 11 is actually the next best one to go to. And you'll notice this is a page that you have seen before. Page 12 is now a new slide. It is the exact same information layout as page 11, but this is capturing Series 2. And then page 13, you will be able to see the combined performance for Neuberger across, which combines Series 1 and Series 2 together. So you can see all the performance together from both. And so if you're looking at page 11, I would say, I kind of touched on this just a little bit, but the numbers for Q3 were down very slightly. I would say it is primarily from new investments going into the ground, being held at cost. We're seeing still very, the performance across primary, secondaries, and co-investments continues to be exactly what we would expect. When we're looking forward to Q4 always takes the longest time period to report for private equity, given its year end and there's audits taking place. However, we are seeing that we expect Q4 to be up slightly. So we'll see how that plays out in the portfolios. We still are waiting on quite a bit of information from the underlying investments, so we don't have a super clear picture just yet, but from some of the early valuations that we have gotten in, we expect Q4 to be maybe slightly above par. Not any big movement one way or the other. I'm going to pause there. I know you guys have a very full committee. I'm happy to go into detail on any other parts of the presentation or more so on these pages. You'll notice page 13 quickly. There's not really much to analyze. We have one investment in the ground, so there's no benchmarking. There's not a lot of performance information to report. So as time goes on, you'll see more information filled in on this page.
Just one quick question. The net IRR is net of both the fund, underlying fund and your fees?
Correct.
So it's just a general question. At the IC, when we discussed the strategic asset allocation, we were talking about opportunities in different asset classes. What are you seeing at Neuberger Berman in terms of PE opportunities, I guess?
Yeah, there's a lot of opportunity. I think from my perspective, I think the middle market within private equity is really interesting. That part of the market has really kept going throughout this time period because of the kind of added part of the market into private credit. What I do like about the market right now is it is still, GPs are being more conservative, and so they're not willing to pay very high prices for assets that they're buying. They're putting more equity into deals as opposed to more debt. So we're seeing opportunities, especially on the co-investment side, to gain some more exposure to assets that we have a lot of conviction around. And I would say just that kind of like lower to middle market buyout is especially interesting in a market that we're currently in, where we can really evaluate and see how assets have performed, not just through COVID, but past COVID and into what was over the last couple of years a little bit more of a volatile environment.
Thank you.
Question, Casey? I like this TVPI number. It looks really good, but the distribution DPI number seems to be not as close. I was just wondering, what's your expectation in terms of distribution of cash flows going forward? Do you expect it to pick up, or do you expect it to stay pretty much the same?
Yeah, so overall, distributions will pick up. This portfolio in Series 1 was committed over a 6-year time period, meaning we were still making investments last year. So the primaries where we were making the first commitment, they're still going to be calling capital from us over the next 2 to 3 years. So we're still going to have capital going out. We will have capital come back. 2023 was, when you historically look at distributions, the worst distribution year across the board in the private equity markets. 2021, 2022, and even 2020 were outsized distributions for those years specifically. And 2023 really right-sized to basically what we were doing in 2019, which when you compare that to how the private equity market has grown over time, that means distributions was significantly down. It was probably half of what it was in 22. So overall, that played into your portfolio specifically, where we did see less distributions last year. We've slowly seen things start to open up. GPs, meaning the private equity firms that we're invested in, are really identifying and coming to terms with the fact that LPs really need distributions. And that's leading to fundraising for their funds becoming longer, because they now understand that in order for us to make new commitments, we need to see capital coming back. So it is definitely a topic that we monitor very closely and we talk to the GPs about. But that is a phenomenon, unfortunately, over the last year to year and a half that we have noticed in the portfolio. So this portfolio in the next couple years should see more coming back, simply based on where it is in the investment cycle, but also hopefully with distributions coming back to the overall private equity market.
Thank you. Oh, and one follow-on question. Do you have a capital market expectation for private equity, kind of like an expected return for this asset class?
I wouldn't have something like a specific number off the top of my head. When we are making investments with the expectation that it is going to be a 2x net TVPI and a 20% net IRR. So anytime we're underwriting an investment, that's our expectation. When we look at public markets, our goal is to outperform public markets by 300 basis points. So maybe that gives you kind of an idea of how we think about it compared to public markets.
Thank you.
If I can jump in, Trustee Kwan, I'll have Laura actually answer your question. Makita does produce capital market assumptions, and we are going to be discussing that later in this meeting, and I will ask her to actually pinpoint that particular number.
Thank you. Thank you.
I had a quick question on the legacy portfolio. I know we talk a lot about the Neuberger permit. There still seem to be some very old vintage investments, and I was just wondering what the status was on the 05, 08.
Yeah, so there's a portion of those that we've sold in the secondary market, so about $60 million worth 2 years ago that we sold out of. And there are some remaining funds that we didn't sell as part of that secondary sale and are slowly getting money back, but some of those cases are fund of funds where the underlying funds still have investments that don't have liquidity yet, so it's taking longer to ultimately get liquidity on those, but it's becoming a smaller and smaller portion of our overall buyout portfolio.
And are those marked externally? I mean,
those are marked by those fund managers specifically, yeah.
Okay.
Externally.
Thanks.
But if there are no more questions for Casey, can we move on?
Yes, please do.
Yes, okay, all right. So I'll turn this over to Laura and Jared for the private markets report and for the subsequent two reports. Thank you.
Hi, everybody. It's great to see you. Let me share my screen here real quick. Okay. Yeah, so like I said, it's great to see you. I'm Jared Pratt. I work for Makita. And Laura Wyrick is on virtually, so you feel free to ask any questions, and then she will cover the capital market expectations update, as Prabhu just mentioned. So let me jump in here to our private markets report, similar to Neuberger's report. This is as of September 30th. Hopefully that's coming through okay. So this is just a snapshot as of 9/30. You can see the Neuberger Fund of One IRR of 20.9% that Casey just covered. Overall, if you look at the far two right columns, you'll see the IRR by asset class compared to a public market equivalent. So that assumes that cash flows came in and out of each of these at the same time to make that comparison. You'll see that that comparison is quite favorable in every asset class except for one, and that's venture capital, which is the newest, and I wouldn't put a ton of weight in that IRR because that's, like I said, it's as you all know, a fairly new program. I'd also point out that the almost 10% IRR at the bottom, that 9.9, is quite attractive in an absolute sense. If we move on to private debt on page 2, you'll see that the target is 4%. The current weight is 4.9%. So that overweight is part of the reason that only one new investment was made in 2023, at least through September 30th. Moving on to page 5, and feel free to stop me along the way, but because of the agenda and a lot of items to cover, I was going to go fairly quickly, but please stop and interrupt where you see fit. On page 5, you can see more recent investments toward the bottom have a quite favorable comparison to peers. So here we don't have a public market equivalent IRR, we have a peer IRR for each vintage year instead. And you can see that more recent investments made by current staff are quite good. Page 6 has more investments, but most of these have immaterial performance at this point. And then as you can see, the diversification page, such as page 7, is quite good for each of these asset classes, particularly private debt, given its age. So you see great vintage year diversification as well as geographic diversification here. Moving on to real assets, you'll see a 2.5% weight versus a 4% target. So a less mature program, but you can see that that green line, which is showing the value, the percentage of assets over time, is going up at a nice pace. And so that will eventually, assuming the target stays at 4%, will eventually get there. Moving on to page 10, this is just a summary by vintage year, and if you look at 2022, you can see 6 investments made in 2022, but none made so far. None were made in 2023 through this point. I'd also point out the 12.1% IRR is great in an absolute sense. Obviously, a pretty large number there for the plan. I can jump ahead to real estate. You see a 4.5% weight versus a 4% target, so fairly close to target in this case. You can see that that green line has kind of stalled out. And moving on to page 16, you see steady and measured commitments over the past few years. So if you look at the far left, you'll see the vintage year groupings and then the number of commitments made in each year, as well as the dollar amounts next to that. So you can see that this has been pretty measured and steady over time. Again, an 11.8% total IRR, which is great in an absolute sense. And skipping ahead to page 19, again, strong diversification by vintage year. A North America bias on the bottom, but still some global diversification as well. And then I'll wrap up comments on page 20 and 23. So for venture capital here, you see that we're at a 1.1% weight against a 4% target, so quite a ways off from target, but again, you see the green line inching up as this is committed to over time in a measured way. And page 23, you can see each of the 14 underlying investments here. You see that most of these don't have material performance to report at this time, as the program is still new. So,
hey, Jared, question on 22 and 23. I noticed the 2020 vintage, it seems like it's, what is it, TVPI of 1.05. It indicates there's not much of a markup. I'm a little surprised if something was vintage 2020 that there aren't any markups since then. Do you have any, or maybe Dinesh? I don't know
Sure.
if you guys
yeah,
know about that.
Dinesh, you mind?
Sorry, I didn't mean to put you on the spot, Jared.
That's okay.
Yeah, it's just with the 2020, I thought there'd be markups in some of those underlying funds, and since the TVPI.
I think Dinesh can expand, but it may seem surprising that 2020 in private markets world is still sort of early. You can see that we're still showing not meaningful returns for 2022 and 2023. So Dinesh can speak about specific funds, but it's not really unusual for us to not see many markups in the first few years of a fund's life.
Yeah, I would add that these funds are still in their investment periods, so they still haven't fully committed to underlying investments. They were also at the earlier stages of the investment period, 2020, 2021, they were investing at a different valuation environment. So they've actually, some of those portfolio companies have seen write-downs because they entered at higher valuations. Perhaps the more recent investments are at cost or might have some small markups, but it's still too early to tell net yet. Yeah. It's about held at cost, and those funds still have dry powder continuing to make investments today.
Okay. All right. Thanks.
Page 11, crest line, what happened with that?
So on page 11 within private real assets, so there are two co-investments that have had significant write-downs, and we had previewed this last quarter when we were presenting the performance reports as of 9/30. So this is, the plans have made two direct co-investments
Okay, then.
outside of a programmatic venture, and the Crestline co-investment 2 is another case where a company ran into liquidity challenges,
Okay,
and
I get it.
ultimately this has been written down to 1.9 million as of September 30th. Subsequently, we got the year-end marks, and they've been written down to fully zero. So this this is an unfortunate case where the investment didn't work out.
Thank you.
Can you talk to us about any opportunities in the real estate space?
Yeah, so actually yesterday I was at a real estate conference in San Francisco, so got to hear a lot of different perspectives there. And overall, it seemed like the transaction market has been slow for about a year and a half as the bid-ask spread was wide. People are waiting for the interest rate move to actually get priced in, a lot of uncertainty about the office sector in particular and what kind of knock-on effects that'll have. But I think overall, the sentiment was positive that the valuations seem to be bottoming. There's more realism about where interest rates are going to be going forward, what type of cap rates that transactions should happen at. So 2024, there's more activity that's starting to pick up, and more traditional type of real estate opportunities where managers can go in, invest some capital, take on some leasing risk, and generate outsized returns as a result of that. Because there are many cases where over the last few years, capital hasn't been spent on certain real estate properties, and compared to 3 or 4 years ago, where it mattered more about what you're purchasing and where you're purchasing those assets, such as buying industrial warehouses for the e-commerce boom or multifamily housing. Those had performed very well 3 to 5 years ago. Now it's more about the individual properties and managers that are able to use their operational expertise to drive value creation.
Can I ask a follow-up question about real estate? What cap rate are they looking for? What's an attractive rate?
It varies by sector and the forward projections for growth, the level of risk, but let's say roughly in the 4.5% to 5% range.
Okay,
That's the ballpark. Yeah.
thank you.
Sure.
It seems like if you look at page 16, I mean, the portfolio's done really well. But we still don't know what the newer vintages will sort of deliver. Given the market we're in, hopefully those will also continue to deliver. So thank you for.
Okay, Prabhu, this is kind of all your section.
Yeah.
Keep rolling them on.
Waiting for me. Can you, Jared and Laura, please take on the next section.
Thanks. Yeah, so switching over to the December 31st pension plan report. I'll just cover markets in a high level here on page 5. So you can see, if you remember, 2022 was quite poor for several asset classes, but if you look at the left graph here, 2023 was an excellent year for most asset classes, commodities being the exception in both of those years. And then I would also mention, this shows January performance of 2024, but looking at performance through yesterday, year to date, something like its global 60/40 would be up another 3%, and that's been led by U.S. stocks, which are up around 7% year to date. Developed market stocks are up around 4% year to date, and then emerging markets are a little bit positive, and bonds are a little bit negative, but overall, your portfolio is up again, as Prabhu alluded to, year to date 2024. I'll keep comments here short, but in general, the economy appears to be fairly strong. There's certainly, several risks out there, but there's also optimism that there could be rate cuts this year by the Fed. And I'd also just mention to you all to keep this left chart in mind because it will be relevant when Laura and our Director of Research, Frank Benham, talk about capital market assumptions and our updates to those, because those have been influenced by last year's performance. So I just say keep that chart there on the left in mind for that conversation. If I skip ahead to your plan on starting on page 29, you see that the plan is approaching $5 billion in assets. With the performance I just mentioned, depending on cash flows, we might be there. For the quarter, there was $59 million in cash outflows, but that was offset and then some by $260 million in gains. Again, that's just for the quarter. You see that all assets are near target. On page 30, we talk about performance here for a minute. You see that a single quarter's return of 5.5% is quite good on an absolute basis, although that did slightly trail the two primary benchmarks, the policy benchmark and investable benchmark. It also trailed peers. As far as underperformance for the quarter against benchmarks, that's mostly just a little bit of manager outperformance. And as far as peers, San Jose plan has a little bit more than the peer median as far as private markets. Private markets didn't do quite as well in the fourth quarter or in 2023. Keep in mind that in 2022, they did quite well. So that explains most of the peer relative performance for the quarter. If we look at the year, and I guess I'd also mention, if you look at the low-cost passive portfolio, that doesn't have any private markets. So you can see that its return was over 9% in a single quarter, well ahead of the plan and the two other benchmarks. So that just shows you what influence private markets had for the quarter. I'd also mention if you look at in longer periods, such as the 5-year, you can see that private markets has generally been helpful as the plan and the two primary benchmarks are outperforming the low-cost passive portfolio substantially.
Hey,
If-
Jared,
sure.
quick question on 29. You mentioned that we're higher in percentage on private markets versus peers. I mean, our current allocation, it looks like it's at 25%. Our peers are in the low 20s? Is that?
There's a couple of specific aspects where, if I jump ahead here to asset allocation here on page 61, so there's larger in real estate, alternatives in general. There's a couple of specific categories where the plan has a higher than median weight. And a lot of these are also kind of self-reported, so this isn't perfectly apples to apples across every peer. But in a couple of these alternative and in the liquid spaces on the right, you'll see that the plan is a little bit above where peers are.
Okay. All right, great. Thanks.
I got a question for you, Jared.
Sure.
On page 29, it shows a negative cash. What would cause that?
Sure, and I know page 29 is, these are from Russell, where the overlay is in place. So I know that actually the total asset number is slightly different than what the custodian reports, I believe, and maybe somebody from the investment team can elaborate, but it has to do with accruals and kind of the pacing, but I'll let Jay give a better answer.
Yeah, thanks, Jared. I don't know if it's any better, but the cash at the plan level is held in a couple different pockets. So you see the immunized net cash flow line. That's quite a large part of plan. That includes a pocket called strategic cash. So the cash line below that, that's kind of operating cash. In effect, though, they're basically both cash.
Okay.
So the plan, if you net those, actually has a very large amount of cash.
Okay.
Thank you.
Thank you.
I just had a quick question. So if you look at the private market summary, we've committed to $2 billion something, and then about 545 is unfunded. So, but this says the private market current balance is 1.2. Shouldn't that be a little higher? At 1.5? Maybe it's too much in the weeds, but I'm just trying to see.
Let's see. So this private markets has 1.2. That's reported by Russell. At the custodian level, we're looking at also 1.2. So, I'm sorry. The $2 billion you mentioned, was that from the other report we covered?
From the other deck, it just says that private markets committed is $2 billion, and unfunded is 500 million. So
I think that's a difference in terms of recycling capital. So some of the funds can call the capital, but if it's still within a certain period of time, they can realize the investment, give it back to you, and then call it again. And so sometimes you see a committed number, or I'm sorry, a funded number, contributed number that's actually above the commitment amount.
Okay, so the official, I mean, not the official, but the book of records is the deck we're seeing now, is that right? Page 20?
Yes, that's right. The custodian, 1.2 billion is the current value in private markets.
Got it, thanks.
Right, and I'd also mention this has committed, but some of that may be uncalled so far, and so what's reflected here is what's actually been being marked and has been called.
And the 1.2 billion includes the private markets proxy. That's why there's a pretty big difference compared to actual private market investments. So private markets X proxy is, as of 12/31, 1.079 billion, but including the proxy, 1.24 billion.
Got it, thanks.
And just on private markets, private real assets, we don't have a good benchmark.
So for private real assets, there's a combination of investments that are underlying this. Half of it roughly is infrastructure, half is in natural resources. So there aren't really any good benchmarks to show here. That's why we try to point people to the private markets report that shows relative to the peer universes of other infrastructure or natural resources funds within real assets.
Okay, that's in the other.
In the other private markets report, right?
And then, so venture capital, is this the 3-year, 6 point, is that kind of what the peer is? Do we know how we're doing versus a peer group?
So I think
still
it's
early, but
too early to tell. And also on this report, the 6.6 is a time-weighted return, so it can be skewed because every period is being measured equally. So some of the early investments might have had some small gains, and then those have an outsized effect on this report. So we really only show the time-weighted returns for private markets to be able to build up to see how the overall private markets or overall plan returns performed over different time periods. But for meaningful measurement, it really should be looked at through the private markets report, which is still too early for venture.
Yeah. And private debt, looks like 3-year number is pretty strong, but 1 year a bit behind. I mean, anything?
Yeah, I think,
Okay.
sorry, Laura, go ahead.
I was going to mention, I think, for me personally, I think the best way to look at how the private markets asset classes are doing is on the private markets report, where we look at the public market equivalent measure. Because the public market equivalent measure looks at if each cash flow was to go into public markets at the same time and come out of public markets at the same time as has happened in private markets, how would that have returned? And so you can see that on the far right here. So the public markets equivalent, for private debt, for example, if you had put each dollar that you put into the private debt program into a high yield benchmark that you could get publicly and got the money back at the same time as well, what would that have returned? And your program, even with those sort of more disappointing early vintage investments, has returned better than it would have in the public markets. And you see that there's a wider gap here for real estate and for private equity as well.
True. I mean, I agree with that, though we do expect that our team can, pick better managers than the peer group, right? I mean, so.
Right, yeah, and I would say that measure is also skewed by some of the 2010 investments that were quite large and underperformed. But I would say for the 1-year return, part of that is coming from the underlying private debt investments we've made. So some of those are focused more on special situations, stress, and in some cases even distress, where investments are held at cost for longer time periods. These are also lagged by a quarter, so as of September 31st, September 30th, they don't have the upswing as public equities. So I think there will be better returns going forward that reflects that increase in the base interest rate and spreads and also some capital appreciation as well.
Okay. And on public equity, I think our outperformance continues, so good job to Christina and Jay. I mean, that's pretty good. And I guess just on commodities, I know we had this discussion a couple of years ago, given the inflation environment, whether we should invest in commodities. We decided not to, and I guess the publicly traded commodities are very difficult to make money on. Was kind of my thought. I think that's worked out.
Ishwar's call. It was your call. I don't know.
Thanks for all the questions. I back up a little bit to page 30 just to point out for the 1 year, the 3 year, and the 5 year period, all performance, using with current staff, that there's outperformance of the policy benchmark and the investable benchmark in each of those 3 periods. And if you look at peer results, they're quite good for the 3 and 5 year period as well. I'll move ahead to page 34 just to talk about the global equity subcategory. I know at the last meeting the artisan funds were discussed. So I just wanted to point out that both funds did well versus their benchmark for the quarter. Now they also did well versus peers for the quarter and for the year. So Artisan Global Value is here on this page. It's done quite well over multiple time periods. And Global Opportunities is on the next page, and it also did well against benchmark and peer for the quarter. So as a whole, you see the global equity category there in gray, and there's some nice outperformance over longer periods with those two funds put together. I'm going to move ahead to page 36 just to point out emerging markets equity. And the gray line, again, not any specific manager. It's kind of the collective result of multiple managers. But you see for the 1 year period, up almost 17%, more than 500 basis points above the benchmark. And a lot of that is with the underlying active managers underweighting China, and that being quite helpful for the past year. And then in the interest of time, I'm going to go all the way just to page 58 just to mention 5-year results versus the peer group. You see on the left an above median return in the 45th percentile, as I alluded to a second ago, but that's been paired with a standard deviation that is in the lowest 15% of the peer group. So you put those two together and you get a top quintile Sharpe ratio measuring risk-adjusted results. So very good results on the return and the risk side of the spectrum for the plan. So with that, I'll stop on the pension plan and see if there's any further questions.
Yeah, on page 35, seems you have 890 million in Russell 3000. Seems like a big number. So is that
yes, that's a large number. I think we and your internal investment team philosophically believe that large cap equities in the U.S. are a relatively efficient asset class. And so having some low-cost passive exposure there makes sense. The right level of that, is anyone's guess, but we're not uncomfortable with the index exposure to one vehicle in this case. And that way, your internal investment team and you all as a board and your investment committee can focus on areas where you might be able to add more value than large-cap U.S. equity.
Okay, so this is not the proxy. This is just a direct allocation to index.
Yeah,
Okay.
our
Okay.
allocation to U.S. equity is 24%, and as Laura mentioned, we believe active strategies work best in like emerging markets, international space. So largely, the U.S. portion is indexed.
Okay, great, thanks.
Okay, with that, I'll jump over to the Healthcare Trust Performance Report, if that's okay.
Please.
So here, I've skipped ahead just to page 27 of the Healthcare Trust Report. You see about 330 million in assets. Everything is near target. Keep in mind that the Healthcare Trust has a slightly lower discount rate than the pension plan. It has no private markets, no hedge funds, so obviously more impacted by public market returns, which, as we alluded to earlier, was a good thing last year. On page 28, you can see performance, strong absolute returns of 7.3% just in the fourth quarter, and an 11% 1-year return. You see that this plan is near policy benchmark returns for 5 years and in. And I would also mention that the peer universe is being corrected. Our third-party performance software said that this was the health and welfare $250 million to $1 billion plan. It's actually all plans in that asset size, not just health and welfare plans. So those percentile ranks for the Healthcare Trust are actually a lot better than this says, because as we mentioned before, the Healthcare Trust has a more aggressive asset allocation than many health and welfare plans. And last year, that was a big benefit. So we'll resend a performance report to repost to the website, but the percentile ranks are actually in the top percentile for this peer group. So I just wanted to point that out. There's mostly passive managers here, so nothing to comment on the manager side. So with that, I'll see if there's any questions on the Healthcare Trust report. Okay, with that, I will turn it over to Laura and Frank on capital market assumptions.
Great. Thanks, Jared. And before Laura and Frank start, I just want to let the board know that, this is going to be a 2-part presentation. Typically, Makita comes out with capital market assumptions at the end of January, and we take it to the investment committee and discuss those. We revisit our strategic asset allocation, and we come back to the boards in March. But given the length of this board meeting, we decided to do this in 2 parts. So Frank and Laura will talk about CMS this month, and next month we will bring back to the board some suggested strategic asset allocation changes. Thank you. With that, I'll turn this over.
Okay, thank you. I'm going to share my screen. Let's go to full screen view here. Thank you for that introduction, Prabhu. Let me go back to the beginning here. I was just looking up in response to a question we received earlier about the premium that should be placed on private equity relative to public markets. And I know that Casey Boyer of Neuberger said that they expect about a 3% higher long-term return for private equity over public equity. I looked up our specifics, and we expect just about the same, more like a 2.5% premium for private equity over public equity, but just wanted to throw that out there in response to the earlier question. I'm joined today, as you know, I'm Laura Wyrick from Makita. Nice to see you all virtually, and I'm joined virtually as well from Boston by my colleague, our Director of Research, Frank Benham, who some of you have seen before in these presentations. Frank has been with Makita for over 20 years and is the architect of our process that develops capital market expectations each year. We have a document here that summarizes our expectations. As Prabhu mentioned, there was an in-depth conversation that we were all a part of at the investment committee. And the goal today is to show you a little bit of our process and what our expectations are for 2024 10 and 20-year returns. And then we'll show how our expected return for your portfolio has changed given these new expectations. But we expect that looking at alternative asset allocation scenarios and getting more into the weeds is something that will happen at the April board meeting. This process, some of you have seen in the past. We do it annually based on end of December data. Makita doesn't, put a lot of our qualitative sort of feelings about markets into this process. It's based on data that we've gathered from a wide variety of external sources. As you know, Makita doesn't buy or sell any stocks or bonds. So for us, this is really an academic process where we don't think we have any interest in making one asset class look more attractive than another. And we currently model over 100 different asset classes. Of course, there aren't really 100 different asset classes, but many of our clients like you might want us to look at, say, what we think the return for Chinese equities are relative to emerging markets, excluding China, or something like that. And so we look at different sub-asset classes as part of those, as part of this study as well. So I will turn it over to Frank. I've let Frank know that you have a lot on your agenda today, so I know he's going to be succinct. But then I will, at the end, talk about your portfolio specifically, and then feel free to jump in with any questions either during Frank's comments or at the end.
Thank you, Laura, and good morning, everyone. As Laura said, I'm the director of the Capital Markets Research Team here at Makita, and given the busy agenda, I want to keep my comments to maybe about 5 minutes, but I'm certainly open to answering any questions you may have. The reason we're talking about capital markets assumptions is because they are a key input to answering a basic question that you as trustees probably have, which is, are we on track to meeting our return objective? So we set our assumptions and reset them every year, but we do so with a long-term time frame. As Laura indicated, we're not really looking to try to time markets or be tactical. We're looking at what the data is telling us in the marketplace and basing our models on that data to give you our best, really, estimates for what different markets are going to do. And we've been doing this for over 20 years, and I will tell you that our models have changed a lot over the years. I would argue that they have improved as we've learned. We've also gotten access to better data over the years. But at the end of the day, it is what is going on in the marketplace, not necessarily changes to our models, that is going to change our assumptions. So for example, if we were having this conversation a year ago, we were looking at what had happened in 2022. And in 2022, interest rates had shot up unlike anything we'd seen in 40 years. And that ended up having a dramatic impact on our capital markets assumptions. In fact, it was the largest increase in our assumptions that we had seen in the 20 plus years that I'd been doing this. Fast forward to this year. All right, well, what happened in the market in 2023? Well, we had a few different things that are really important. We did see short-term interest rates continue to climb, so the Fed funds rate went up a little bit. But for longer-term bonds, particularly, so thinking about Treasury bonds, interest rates stayed pretty close to where they were at the start of the year. They moved around a lot, but at the end of the year, for example, the 10-year Treasury, the yield was exactly where it was at the beginning of the year. Now, for some lower quality bonds, things like high yield bank loans, what we did see is sort of yield compression in terms of the credit spread. So the credit spread, you may recall, is the difference in return expectation, or really difference in yield that you're hoping to get paid for investing in a higher risk bond. Credit spreads came in 2023, basically reflecting that the market thought, it was a less risky environment than it was coming into the year. And that flows through to a lot of those fixed income asset classes. As you probably are aware, 2023 was a very volatile year for equity markets. Started off great, then it went south, and then it finished great. The net result is that for most, particularly the US market, but for most markets, we saw increases in prices, but what we didn't see was quite as much of an increase in earnings to keep pace with those prices. So from an overall valuation metric, valuations got higher. And that's important because from a modeling standpoint, and I'm not going to get into the details with this group, we take valuations into account. We're firm believers that the price you pay for an asset is going to be one of the key determinants of the return you're eventually going to get. So the net result of all of this was honestly kind of offsetting. And at the aggregate level, not very big changes. So I'll tell you that having looked at a number of our different clients, institutional pension plans like you in particular, we're seeing their expected returns change by, I'd say, on average 10 or 20 basis points relative to last year. So let me fast forward, if you would, Laura. We will jump through over the process and go right to the numbers. So maybe go back actually to that page 6 for a second. Actually 5, sorry. Didn't read quite fast enough. Okay. So this is the one thing I'll point out about our models. Some of them are going to be better than others, and that's just the nature of the data and how predictive the data can be. So if you look at the chart on the top left of this page, it's showing you what the yield was for in this case, the Bloomberg aggregate, or the broad investment grade bond market, at the beginning of the period, and then what the return was for the subsequent 10 years. What it shows you, quite simply, is that the yield is a very good predictor of what the bond market's going to do over the next 10 years. And honestly, that's maybe the most predictive model that is available to us. If you look at some of the other asset classes here, you'll see, there is some information to be gleaned from the data, but maybe not quite as cleanly. So the top right is the yield on cash versus the return over the next 10 years. And there's a relationship, but there's a lot more noise there. Same thing if you look at the bottom right, what we're looking at instead of yield is valuations, in this case a PE ratio, a valuation metric, and comparing that to the return for US equities over the next 10 years. And again, you see there's that relationship I was mentioning, the more you pay for, in this case, equities, the lower your return tends to be, but there's certainly wiggle room around that. All right, so why don't we jump ahead to the individual asset classes. There we go. So these next few pages, I'm going to go through very quickly. They just highlight our changes for major asset classes for this year relative to last year. And what you see on this page are mostly high quality bonds. For the most part, expectations are flat to slightly higher. And that's because even though interest rates didn't go up in the near term, or current interest rates did not go up, expectations for future interest rates, so what the 10-year Treasury is going to be yielding 10 years from now, went up. And we take that into account when we look at our long-term return projections. And that flows through not just to the bond piece, but to a lot of the other pieces as well. The one asset class on this page that really stands out is cash. So even though cash rates went up, the expectations for cash rates over the next 5 to 10 years went down, and that's what's showing that reason. If you go to page 14, you'll see the lower quality bonds. So this is high yield, bank loans, emerging market debt. So I mentioned credit spreads tightened. So you see the return expectations came down for high yield and bank loans. Emerging markets, we did not see that same tightening in credit spreads, so they actually went up a little bit. The next page is equity. So this includes both public and private market equities in US and non-US. As I noted, valuations went up for most equity markets, so our return expectations came down. I'll add one side note that we talked about last week at the investment committee meeting. One thing we changed is our currency return expectations. And not really the return expectation so much as a cap that we put on it. Even though we have a lot of faith in our models, the one piece we've honestly had the least confidence in historically has been the ability to predict currency returns. And if you have non-US currency exposure, that is going to impact your returns. So we actually decreased the amount that could affect our return expectations. And what that meant is, effectively, it took 50 basis points off of the return expectations for non-US equities. So you see the developed non-US and emerging market equities. If we hadn't made that change, those would be 50 basis points higher. But this was a structural change, or someone noted last week, a recalibration of our models. The next couple pages get to real assets, so things like real estate, infrastructure, natural resources, etc. Real estate was, I'd say, had a positive turn, literally. We saw cap rates, which are essentially an expectation of yield on real estate, go up for the first time in years. And what that meant, this is kind of a good news, bad news thing, was that prices had gone down. And you saw that in returns that Jared was just talking about. So with real estate prices coming down, that has the silver lining of future return expectations going up. Infrastructure, we have less good data for, but we have return expectations going up there. And then the next page, I don't think you have much exposure to natural resource and commodities. So maybe I'll skip ahead to the final page, which is hedge funds and other miscellaneous. And generally, if you see cash expectations coming down, that's going to bring hedge fund expectations down because a lot of hedge funds are sitting on cash. And maybe the last thing I'll note here is the peer page, Laura. So we do track how we do, and the last couple pages you saw, we track how our expectations have done historically, but we also track our expectations versus peers. The best data that we're aware of is a survey that one of the actuarial firms conducts every year. Unfortunately, they don't publish it until July or usually August. So I don't have a comparison of how our numbers stack up this year. We do know how they stack up for last year. We do know that when there's a year where valuations change a lot like they did in 22, that because we take valuations into account more so than I think our peers do. I obviously don't know exactly what all of our peers' models are, but when that happens, our numbers tend to change more. This year, when the numbers come out, I expect you'll see our numbers will be a little bit closer to the average of our peer group. We tend not to be systematically over or under. There are some asset classes individually where that has been the case historically, but we do tend to be in the ballpark. So I will pause there and open it for any questions anyone has.
Maybe I could just mention quickly before we fully open for questions that we show on a couple of slides here the policy targets for your plan and the 2024 expected return relative to 2023. And then we have a summary of how that impacts our total portfolio expected return and standard deviation here. So we have a 2024 long-term 20-year expectation for returns of 8.3% for your pension plan, slightly lower than last year, but still significantly above your actuarial assumed rate of return. The expectation for standard deviation or volatility or risk has also come down by a greater degree, leading to a Sharpe ratio, or a measure of risk-adjusted return, that is higher than it was based on last year's expectations, which is a good thing. As you know, your risk advisor, Verus, is the official calculator of your standard deviation or risk. And as Frank said, every firm has different models and different methodology. Verus's standard deviation expectation is 11%, also lower than last year. We have a further breakdown here just on the 3 functional asset classifications that you have in your pension plan of growth, low beta, and other. But with that, I will end this presentation from our end, and Frank and I are happy to take any questions.
I'm not seeing any questions down here. Thank you.
Thank you very much.
Thank you, Laura and Frank, and thank you to Makita and Muehlberger for covering performance and excellent questions from trustees. Thank you for those questions. We have one last agenda item, and
I'm sorry, Prabhu, if I just may. So this one was agendized for discussion and action on capital market assumptions. I know you said that we're going to split this out to have asset allocations and those assumptions at the next following meeting. Is there any action from your office that you're requesting for this agenda item?
Not really.
Okay.
I don't think there's any action required here.
Okay, so we would, no action taken.
Thank you, Mita. And for the next agenda item, I will turn this over to Jake Wan.
Good morning. So we just went through this at the IC, I think less than a week ago. My apologies to the IC members. I really haven't changed the script at all, so it's going to sound a little repetitive, but we'll be brief. So it's a time of year where, in addition to the review of the capital market assumptions and strategic asset allocation, the plan also goes through the pre-funding process. And if you remember, I think everybody's been around before, but that's the little dance that we do with the sponsor, where the sponsor decides the frequency at which they want to make their sponsor contribution payments. So the default is every 2 weeks alongside payroll, but they can choose, as they've chosen in the past, to front load all those payments to the beginning of the fiscal year. And they can actually choose other intervals as well, but those are the 2 most common. And so if they decide to pay, if they decide to pay up front at the beginning of the fiscal year, the amount that they pay is different because they get a discount, right? That string of payments is discounted by a certain rate. And the board gets to decide the rate at which those payments are discounted, as long as that decision is actuarially equivalent to that default every other week string of payments. So in this process, you all get to decide the discount rate, and the sponsor gets to decide whether they will pre-fund. So in order to make this a little bit less ad hoc, about a decade ago, we, being staff, we recommended, and you all adopted a process to make this more systematic. And so we created 3 triggers, financial, economic, and valuation-based, that if any of those are hit, then we start shrinking the discount rate that's offered to the sponsor. The appendix to the memo shows that none of the triggers were hit this time around. And so the recommendation, in line with the existing methodology, that again is about a decade old now, is to offer the city the full discount rate. And the full discount rate would be the discount rate for the plan, which is 6 5/8. Just so you know, by background, we're talking about $217 million in sponsor contributions for police and fire, and for police and fire pension, and then about another $31 million for the OPEB. In the past, the city's only chosen to pre-fund Tier 1, so there's the Tier 1 contribution and Tier 2, so they, when they decide to pre-fund, they do Tier 1. And if we offered them the full discount, as the methodology suggests, they would have fiscal kind of budgetary savings of about $6.5 million. Are there any questions?
I'm not seeing any. So this is an action.
Require action.
Yes, it does. So the recommendation would be to offer the city the full discount.
Okay, there's no questions, and I'll entertain a motion.
I would make that motion, but I'd like to hear from the investment committee for their recommendation.
Okay, I'll move the motion to adopt the investment staff recommendation that we provide the full discount.
Okay.
Second that.
We got a motion from Eswar and a second from Dick. Any questions? Hearing none.
Aye.
All those in favor?
Oh, sorry.
Aye. Sorry.
I jumped that.
Blanked for a second.
I need some coffee.
Any opposed? Okay.
She was happy today. I happy.
Before we move on, we've been at this for a little bit. Why don't we take about 8-10 minute break?
Thank you.
Coffee as well.
Yeah. Are we taking lunch?
just, wait, nope, got up. All right, let's move on.
Recording in progress.
Okay, we'll be going to number 3. Actually, we have nothing under 3. We're going to number 4. It's going to be new business. We're going to take a couple of things out of order here. Pam, I know, has to leave, so she's going to give her report first, and then we'll take Roberto's.
Great, thank you, I appreciate that. Just a quick report, about a month or so, at City Council, we eliminated the ability for public commenters to call in, and so you have to now be present in order to make a public comment. That's a result of a lot of anti-Semitic comments that we were receiving, a lot of racist hate speech, and so we are working on a new format that will allow everybody to comment in some way, but we haven't figured out how we're gonna be able to do that just yet. But so, just wanted to let you know, I know I don't know if you've made that, adopted that yet. Also, I appreciate the discount on the prefunding. That will help our budget because we have a 5-year projection that isn't heading in the right direction. We are in the middle of the budget process right now, and the focus will be, as it has been in the last year or so, public safety, homelessness, and blight. Those are the main drivers of our budget at this point. Also, we are in contract negotiations with our firefighters. And with that, that's all I have to report at the moment. Let me know if you have any questions.
Hey, thank you. I don't see any questions, so we'll move on. We'll go from oral update, Roberto.
Yeah, thank you, Mr. Chair. So just a quick update. So let me just look at my notes. A couple of things. Retiree from police and fire that are impacted by the Internal Revenue Code Section 415 bill limits will see their 2024 adjustments in their March retirement payment. There are not as many employees impacted on police and fire as we have in Federated. We do have just a tiny bit more than a handful, but just wanted to let you know. The next, our quarterly newsletter, which we obviously issue on a quarterly basis, will be distributed in April to retirees and members. Our offices will be closed on April 1st in observance of Cesar Chavez Days. And I wanted to turn it over to Barbara, who was jumping at the opportunity to update you on the issue related to the annual Medicare Part B reimbursement for police and fire members. There's a lot of detail, and I just felt that it would probably make more sense if she updated you on that part than I did. So with that, I'll turn it over to Barbara.
Thank you, Roberto. So yes, annually we, in February, well, the process starts off in February, the Medicare Part B reimbursement. And this year we initiated that process, same timeline. There was an issue with the initial letter that was sent out. Unfortunately, our vendor sent the prior year's information, but staff have taken corrective action and have sent, including an apology letter and the corrected letter and forms. And I hear from Sandra that we've received so far over 500, so the process is well underway. Reimbursements have started, and they started in February, and we'd expect that the final ones will maybe be paid out in May, but every month we'll be paying them out as they come in. Oh, and members have until April 1st to get their information in.
Very well, thank you, Barbara. Mr. Chair, those are our comments. I'm happy to address any questions if there are any. Thank you.
Not seeing any. So we're gonna take one more item out of order. I see the cities here. Why don't we get you guys up so you can cover item 4E.
And so for your benefit, I'm going to read to you how the item reads. Discussion on proposed city ordinance to amend San Jose Municipal Code, Part 4.12 and sections 3.36.385 and amendments to Section 7 of the City Sunshine Resolution. Good morning. Good to see you both. Welcome.
Good morning, Chair and board members and Office of Retirement Service staff. My name is Kevin Fisher. I'm the Assistant City Attorney, authored the memo that's in front of you. And this is Cheryl Parkman from the City's Office of Employee Relations. We don't have a presentation for you this morning. We're here to answer any questions that you may have. And I think the memo speaks for itself. This is submitted to you pursuant to direction from our City Council from their October 24th, 2023 council meeting. And with that, again, we're available to answer any questions you may have.
So if I may advise the board just on the background and process for how to respond to some of these ordinance changes. So under the Muni Code, it provides the board 60 days from receipt of a proposed ordinance to review and comment on the proposed changes. Excuse me. And then to submit that response to the City Council for their consideration prior to adoption. I recommend that we have both Tax and Fiduciary Council review the proposed changes for two perspectives, one under our constitutional fiduciary duties and also to maintain the tax qualified status of the plan. My understanding from speaking with Mr. Fisher during the break is that these proposals have not been run by a tax council quite yet on their end, and so we would recommend that we would do it on our end because as fiduciaries we do have to protect the tax qualified status of the plan. And so I'm requesting direction from the board to engage with tax counsel. We currently have two tax counsels on hand. One of them is currently Ice Miller, which we share with the city, and the other one is with Jenny Kringle from Buckalter, who is our separate tax counsel that walked us through the Sadro issue that we dealt with last year. And my recommendation would be for us to go forward with direction from the board to engage with Jenny Kringle from Buckalter to the extent she's available. Excuse me. These proposed changes are currently under review with my office, and we are not in a position to fully comment on it, but I do have two questions for the city, if I may. Excuse me. So one of them has to do with the provisions here that say that there's a number of types. So I'm sorry, let me just pull this up. So under the code section, subdivision A, regarding the contracting authority of the board, it says that subdivisions 1 through 6, which relate to actuarial services, auditing services, investment manager searches and services, investment performance evaluations, and proxy voting services, and other consultants that are deemed necessary to carry out the responsibilities and duties of the plan, which do not fall under the definition of services as determined by the finance director. And then in subdivision B, it says all other goods or services shall be, it says that all topics covered through subdivision 1 through 6, which I just summarized, would be subject to the city's contract and procurement process. And then it goes on to say in subdivision B, all other goods or services as described shall be procured by the finance director. And then subdivision D, it says all contracts must be in the name of the board. And so my question there is that if we were not content with the procurement that the director of finance did, would that be an agent of the board, or how would that work out? Since we're a party to the agreements.
So the, let's see.
So putting services aside, for example, just the remaining goods and services, if we were not satisfied with the procurement decision of the finance director, does the board have a chance to challenge that, or how would that work?
The procurements that are run through the director of finance under B, the second sentence in B.
Yes, yeah.
Since ultimately those contracts would be entered into by the board and the plan, then the board and the plan obviously would need to approve those contracts. Yeah.
Okay.
Yeah.
Okay. So we may seek some clarifying language just around that, just so you're aware.
I get your point.
Yeah. And similar question, if you turn with me to, I think it's 4.1210, the definition of city. And it's in attachment B. There it lists the definition of city and then includes the two boards in the definition of city. This is in contrast with other provisions in the municipal code where the boards are treated as separate legal entities. And so I'm just trying to understand what the idea was here.
We added the boards in the definition of city here to just clarify. It really goes almost to the point you just made, that the boards are the procurement authority, have the procurement process under 4.12.
Okay,
so it kind of goes to the same point.
Okay, so if I'm understanding these changes correctly then, based on our conversation here, is that the procurement process would be adopted by the boards. However, the boards would have the ultimate authority to decide one way or the other following that process.
On the award.
In the award.
Actually the approval of the contract.
Okay, okay, that's the main point that I needed to understand. Thank you.
Sure.
Can I ask a silly question, I guess? So in essence, if we as in the Office of Retirement Services is procuring some services for the boards, the process will remain similarly to what we do today? In other words, it's presented by our staff, or is it because it does indicate finance, is the finance director going to be sitting here making the presentation on behalf of the city so the board can approve it?
So basically what we're doing here is the ORS would be like other city departments. So you would ORS would run the procurements for items 1 through 6 under 3.36385. You would follow our process, which is set out for the ORS in subdivision C, where you would the CEO would be the procurement official. You would hear any protests. You would follow the process in 4.12 as a department. You, as the CEO, would hear any protests, and then the protests could come to the board for if the protester didn't agree with your decision. So essentially, you would be following this same process for your contracts under 1 through 6 that the airport follows or any other city department, and then for goods and services that are covered under 4.12, like computers, pens and pencils, things like that. Finance would procure those, but to your council's point, the contracts would be entered into by the boards.
That's well explained. Thank you for the details. I'm not as knowledgeable of the process as maybe my staff is, so let me ask a question of staff, because you explained it to me now, but I'm sitting here thinking, how is that different to what I do today? So let me ask Benji first. How much difference is that to what we do today?
There really isn't. We try to follow the city policies as much as we can.
Okay.
And, we go to the board for.
But isn't already that? I'm not trying to be difficult. Isn't that already in the meeting code? I mean, that's what we. I'm just trying to understand what was the need to write it again.
I would refer you to the council discussion on October 24th.
Okay.
We're acting pursuant to council direction.
Okay.
And I think there were, well, as you know, there were some questions about whether the ORS would need to follow the city procurement policies, but yeah.
Fair enough, thank you.
Yeah.
So again, we have 60 days to respond, and so I anticipate by the next April meeting, I will become prepared with tax counsel to provide you our recommendations.
And just so if I could note, our office is available to have further discussions with your council. Also, staff is available if our ORS staff has any questions during this 60-day period. We're available for questions, comments, discussion.
Thank you very much. Good to know. Thank you.
I have a basic question. The red lines are yours, or are they our? So
They're ours, yes.
Okay, so this was changed? Something was changed for some
Yes,
reason?
we're amending our ordinance, so the red line shows the additions to the current ordinance that were directed by the city council.
Okay. All right, thanks.
I apologize, I was finishing my bite. If there's no other questions and you guys have nothing else.
I'd say we're here to answer any questions. Thank you.
Thank you for the clarification. Appreciate it.
Thank you.
Just a comment, if you may, Mr. Chair. Maytag, isn't this the one that is included in all the ones you went through in the government, in our government, last meeting we had, because you went through a whole ton of them, and gave us the same advice in terms of being more insensitive and supportive of city policy.
Sure. So if I may, on that point, at that same October, was it October or November? I can't
It was
remember.
October 24th.
October 24th city council meeting. The mayor directed and the city council approved a number of different things. But here today, as relevant to our discussion, are two things. One, that the city attorney's office go back and amend the code to provide that ORS follows the city's procurement process. And as relevant to us, the mayor and city council directed the boards to evaluate all city policies and determine which ones were suitable for adoption and to report back their status. So in our processes that we've had done to date, we've completed two phases, so to speak. Phase one was essentially the low-hanging fruit, which obviously the ORS would seek to adopt because it's prudent to adopt those policies. So that was done in November and December. We reported back to City Council at that time. We just completed phase two, which is what you're referencing in our meeting before, which are the ones that are a little bit more complicated. Some of them had to do with HR issues because we had to be sensitive to Measure G. Others had to do with the wording in the city policies that state what we do with revenue posting, for example, and tax collection and accounts receivable. It was just worded in a way that just doesn't apply to our board. That being said, though, it was a useful exercise in identifying gaps. For example, how do we handle checks? One of the next agenda items will go to show some of the proposed changes that we'll be recommending to you to recommend to City Council to adopt for the operations of ORS. Because even if we were, like I described at our last meeting, even if we were to adopt some of those city policies as written, they just don't apply to us. We don't collect taxes, for example. And so that's what I was saying before. The vast majority of the other city policies in phase two we did adopt. There were a few that we recommended adopting and then providing further clarification to the city council, and that's what I'll be presenting later. On the contracting and procurement piece, that was in phase three because it's much more delicate, as you can tell. And we have not, as a board, voted fully on what our contracting and procurement processes would be as applied to ORS. And so this is a parallel track between the city and our boards on contracting and procurement. So the only two issues that are saved for phase three now are travel policies for the board and contract and procurement. So that's phase three. So we're currently done with phase two, though.
Thank you.
Okay.
Thank you.
Thank you.
Good to see you. Thank you. Mr. Chair, I wonder now if just to continue with this process to jump to the next item next to it, which is
item F.
Yeah, what Council Chin just mentioned, right? Since we already kicked off this discussion with the city, we might as well, unless Meta preferred to do it later.
Yeah, sure, I can do it now. It's not a big deal. Probably faster that way.
Okay.
So if I could please go to item F. So this piggybacks on my explanation I was providing to Trustee Santos. As you recall, at the last board meeting, the board adopted a matrix of phase two city policies, which covered the topics of health and safety, employment, HR, training, and financial policies. A few of the policies as written didn't cover ORS's operations. As I mentioned just a few minutes ago, the financial policies relate to revenue collection, taxes, and whatnot, and doesn't discuss what to do with plan assets. And so there's a gap that needed to be remediated, and that's henceforth the policies here I'm providing to you. And also another policy that's listed as well here is the city's disciplinary policy that specifically carved out ORS from the coverage of their disciplinary policy. And so with the backup materials here today, I'm here to present to you the proposed red lines that we are going to be recommending to City Council. So I don't know if the board has appetite to go through each and every policy, or if you would like a high-level description of what each policy entails. I'm happy to do either way.
Is this part of the Cortex project, or?
No, this is separate. This is what Reed Smith was handling.
I think
High level is probably
level.
good.
And then we can dig down if there's specific questions.
Yes.
Sure. So if we can start with the first policy in numerical order, which is City Policy 2.13 on discipline. What we did with this policy was conform it with Measure G. Measure G provides that the board has authority over HR issues over the CEO and CIO, and that in turn the CEO has jurisdiction and authority over HR issues of ORS employees. And so we revised the city policy here to reflect that the CEO would be serving in the capacity of OER as applied to ORS. And made reference to Measure G in our separate board charters for disciplinary actions of the CEO and CIO. Any questions with that one? Hearing none. So the remaining policies in the 5 series, there's 4 of them here, 5.3.2, 5.3.4, 5.3.5, 5.3.7. These all relate to check processing and recording of payments, accounts receivable, and check handling procedures. And so I worked with ORS's accounting department, specifically Ms. Benji Chuafoy, and they reviewed these, and these accord with their current processes in place. And so these do accurately reflect ORS's processes. And so we would recommend providing these to the City Council so that they can adopt these. As you'll see at the end of each of the policies, I left it blank. So these would just, rather than amending their current policies, these would just be adopted per recommendation to follow in series.
So Maytag, so at the end of the day, we have ours, ORS policies, and then the city has something that they can look at that reflects the same thing in their whatever, their documents?
Only with regard to these.
Yeah, these
presented
things,
here,
yeah.
Correct.
So, because we have our own.
Right.
Okay, and they'll be consistent.
Right.
The other question, what's the expectation? Are they just, you think they're just going to accept it and that's the end of it? Or are we expecting to spend more time going back and forth?
That I can't tell you. I can't read the City Council's mind. What I can say is that we put up our justifications or red lines very similarly to how they have presented theirs, and they're free to pick and choose. To the extent they, violate some of our fiduciary duties or violate Measure G or the policies and authorities that are legally granted to the board, we may seek litigation if they do that. But let's hope that we can work collaboratively with the city and they adopt these.
Okay, and it doesn't stop us from doing our work. I mean, with anything that needs to be done in the next month, 2, 3 months, right?
Right, so if we were to adopt these and then also recommend these to the City Council, these would be policies of ORS.
Okay.
So for example, disciplinary measures of employees.
All right, great, thanks.
Mita, I'm a little confused. I'm sorry. Maybe you covered this and I missed it, but why is this not, these policies are not part of the matrix, or it's not being reviewed by the governance committee? Why is that?
So these policies are from the matrix. However, we are bringing these red line changes directly to the boards because we are required to report back to the City Council on, I believe, in April 16th.
Yes, at this point, April 16th.
Okay, so that's why it's coming directly to the board. But it's part of the same matrix.
Right.
It's just certain things where we want an amendment. Understood. Thank you for grounding me.
So it's up for excuse me. So my recommendation would be for action taken to accept these as applicable to ORS and to present these proposed changes to City Council for adoption.
I have a question. Do all city departments have their own auditors like we do, or? I don't mean internal auditors, external, financial auditors.
No, there's only one financial auditor, I mean, for the financial statements for the city. Yes.
So, but we are different in that we have our own.
Correct, because we issue our own statements.
Yeah.
Yes. And there are some departments that issue their own statements, but they are within the city. They are part of the city department, so it is part of the overall evaluation by their external auditors. Yes.
Right, understood. So I'm just wondering, like, for something like where we are talking about, I think it's in the check processing, I kind of looked at a few of them, but where we, where there's a financial element of these controls, is it worthwhile pointing out that we are audited externally by ourselves, not, it's not just the CEO making a decision, there is an auditor process. It's like any other company or.
So I hear what you're saying, and I think philosophically speaking, yeah, that could be possible, but I just want to state that the financial auditor, they're going to be issuing an opinion on the financial statements, so they're not really looking at the auditing the operations per se. So it could just so happen that as part of their testing, one of those contracts may be part of it, but it's not their goal of their audit. So,
I understand.
So I'm not sure that will suffice. I don't know if you have any further comments, Benji.
No, and also the financial auditors are looking at the materiality of an amount, whereas, these could fall under a certain amount, and they would not be looking at them. So, I mean.
Yeah, no, but that's true for any department.
Right.
All I'm saying is that the difference between ORS and other city departments is we have an external auditor looking at our financials
Well, I think.
every year.
So if I may, the difference between us and other city departments, if we go back to just looking at the various bank accounts, the city has one bank account related to the city funds and applies to most every other department. ORS has a different bank account, which is plan assets. And because of that, these financial provisions relating to city funds don't apply to us because we have plan assets. And so that's where the division really lies.
Yeah. Understood. Anyway, it was just a suggestion, it wasn't a requirement, so, thanks.
Any further comments?
With Benji's help. Benji was very helpful with the financial ones.
I would like to make a motion to accept the proposed changes as expressed by council.
Second.
I had a motion from Wilson, second from Dick. All those in favor?
Aye. Aye.
Opposed? Okay.
A lot of work.
I know.
Phase 3 is going to be fun.
Well, phase 3, we'll have to discuss how we go forward with that. Those discussions will be had at the governance committee first.
Okay. I think that takes us back up the list to 4C.
Yes, thank you, Mr. Chair. So 4C and 4D, they not going to be together, but right after the other. So I'm going to kick it off and then turn it over to staff. As we do every year, staff is ready to come before you to propose the ministerial budget for you next fiscal year. But before we do that, we do have some requests to adjust the current fiscal year budget, which is item C. So you're going to hear first from staff on item C on the reason for the adjustments that we're requesting for your current fiscal year, so that when we present to you D and we speak about this year's budget and next year's budget, this year's budget already assume that you will be approving the request on item C. So with that, I'll turn it over to Benji. I think she's going to be presenting the item 4C. And Barbara, actually, I wanted to present 4D, but she just could not wait to do that. And I said, that's fine, this is my last year. Why don't you present it? I just sit back and watch you do it. So with that, I'll turn it over to Benji. Thank you, Benji.
Okay, so this item is requesting $200,000 for personnel services and $500,000 for professional services. So the administrative budget is broken down into 4 categories: personnel, non-personnel equipment, professional services, and medical services. So during our review of the budget for the new fiscal year, which Barbara will be presenting, our analysis resulted in showing shortages for those two categories. So for personnel services, last year the City Council approved an increase of 6% for city employees in order to avert a strike. Only 3% of that was budgeted. So we are requesting an additional $200,000 to cover that.
Hold on, Benji. Can I ask staff or someone to bring up page 2 of the memo because the details in there? And then if we just go slow so that we can, the board can follow the numbers and everything else, that'd be great.
So, that's good, thanks. So as you can see there, the approved budget, original budget for personal services was $4.7 million, $4.8 million. We're requesting an increase of $200,000 to cover the shortage, and it'll increase it to 4.9, almost $5 million. The other shortage is in professional services, going from $900,000 to 1.4 million. And the reason for that is for legal services, we have had a lot of need for legal services for this fiscal year, not only for tax, but also for fiduciary and for disability, so because of the additional work that they're doing in disability. So with that, we are requesting 1.4 million. Let's see, it's for the fiduciary services. We took the latest invoice, which was the highest it's been for since for a while, and we used that to estimate the rest of the year, since it's really difficult to predict how much they're gonna we're gonna get billed. We also want to make it clear that if the board approves these increases, it doesn't mean we're going to spend all of it. We just want to make sure that we have enough so that we don't have to come back again at the end of the year. Are there any additional questions?
Hearing no questions, I think there's a discussion and action, so we'll entertain a motion.
I'll motion to approve.
Motion Dick,
I'll second.
second Wilson. Any further discussion?
Yeah, just a comment. If I was the regular Joe and I saw this and you go from something like 500,000 to 4 million, you probably wouldn't understand the whole process. And working in another government, just addressing homeless issues and environmental creeks went from 500,000 to 4.5. So I do understand these things. Not necessarily do I like them, but you don't have much choices today. The same as our administration when it comes to the medical, the disabilities, everything is tripled. So I'm not just saying it to support it, I'm just trying to explain to the regular Joe who looks in and goes, what's this about? A lot of hard work and costs are tripling. We're doing the best we can to reduce it and keep it stable. So that was my motion, and thank you.
Okay. And
Just one question. When you start the 24-25 budget, will you start with the 7.6 or the old number as the baseline?
Well, it's a factor of multiple things. We'll look at prior years to see how much it's gone up, and then we'll look at prior year, the past 3 years. Usually for professional services, we'll look at the past 3 years, or, well, it used to be past 5 years, but because of the changes that's been happening for the past 3 years, we decided to change it to the past 3 years. So you'll see it go down a little bit too, so, hoping that a lot of this have gone down.
So it's a long way of telling you that we anticipate what the expenses may be. As you know more than most people, we were not expecting a lot of the issues that we are dealing with this year. So I would think that next year, if I had to present the budget for next year, I don't think that we're going to have the same kind of expenses on the legal side. I think this year is extraordinary. So I don't know if that answers your question, but that's
Yeah,
how
I mean,
would look
I
at
think
it.
the spirit of my question was, do we treat this, it's about a 10% increase.
Yes.
As a one-off? Or are we treating, it sounds like a portion of it is permanent and a portion of it is.
That's right. So it's more of a one-off than anything else, but I think to Benji's point, what we have learned over the last few years is, because I find myself explaining the same thing the last couple of years, as I'm telling you now, is that maybe the last few years have become more of a norm, So we don't know what we don't know, right? So we will take some of that and apply it to next year, but I think the overall hope is that it will be a lower cost. I certainly don't expect next year to be as challenging from a expenses project standpoint as we had this year, yes.
And just to add to that, for personal expenses, we've never had to come to the board to ask for more. It's just because now we're more fully staffed that it's, you know, in the past, the vacancies have absorbed any increases we had, whereas now I think we only have one vacant position. So it's, you know, getting closer to the budget.
Thanks.
And the last thing, Mr. Chair, is that the men and women that wear the uniform and put their lives on the line deserve the best services.
Agreed. Okay, I think we had a motion and a second. Anything further? All those in favor?
Aye.
Opposed? Okay. We're now moving to Board D, discussion and action on the proposed administrative budget for fiscal year 24-25.
So Chair, that is me. Good afternoon, Barbara Heyman, Office of Retirement Services Deputy Director. This item before the board is seeking approval for the budget for the upcoming fiscal year 24-25. And I'll go over the budget presentation with you now. I'd like to thank Benji and her team for preparing the budget and presentation, as she does annually. And she actually just let me know that she had a couple of comments that she wanted to make. I think she had a couple of corrections she wanted to point out, so I'll just pass it over to her for a second.
Sure, I can do that now, but it's in the personal expenses. The presentation is fine. We had adjusted because we're going to be funding half of an IT cybersecurity person that the city IT department will be requesting, but we will just be requesting funding for 50% of it. We removed that from the org chart, but I neglected to remove it from the detail in the memo. So apologies for that.
Thank you, Benji. So if we go to this first slide, it's showing us the overview of the budget presentation. We'll go over the development of the budget, the administrative expenses breakdown, sources of funds, followed by the uses of funds, and then the proposed administrative budget, the personnel services analysis, non-personnel equipment analysis, the professional services analysis, medical services analysis, and then finally the comparisons to other California plans. So if we go to the next slide. So if you look at the agenda, there's two backup documents here, and these budget documents included on today's agenda are the exact documents that are sent to the budget, the city's budget office, as well as City Council. So for several years now, the sources and use have been included, and including this was a recommendation that came out of a prior city audit of ORS back in 2017. As part of that same audit, there was a recommendation, which is actually still outstanding, to include in our administrative budget costs associated with the investment expenses. We at the office and you board, based on your general counsel legal analysis, were not able to meet that particular audit recommendation. And that was for a number of reasons, two of which are state retirement law usually indicates that investment earnings are used to pay investment-related investment expenses. And by those expenses, I am really referring to the management fees. And the second is we don't always know, or we never know really, what the future is going to hold and what the market is going to do in the upcoming fiscal year. So that leaves it very difficult to determine how much in management fees we would be requesting the boards to approve. So I can give you an example, looking back at earnings for 2021 versus 2022 for the police and fire. In 2021, our earnings were 26.19 positive, and 2022 they were 5.08 negative. The difference in manager fees for those 2 years would be considerable. And the 2023 earnings were 7.65, so again, quite different from 2022. Now that said, we were able to agree on, where we weren't able to agree on that, we did understand that the basic premise was transparency. So to that end, staff has provided an estimate and they include what management fees may be in the coming year, assuming that the asset allocation returns the assumed rate of return, which is at 6 5/8. So first they look at the actual asset allocation, and then they assume we're going to return the 6 5/8 to provide some estimates. And then in addition to that, every August, investment staff produce a comprehensive investment fees report that is calendar year basis, and they come before you boards in August for a presentation, and the CIO goes in front of the City Council in September and makes that presentation as well. The point being, we do agree with the City Auditor and City on the point of transparency on the issues, and have taken steps to remedy that audit recommendation. So with those comments aside, I'll just continue with our budget presentation. We have the sources of funds, and those are city contributions, participant contributions, and investment earnings. Those are our three sources of funds, and then we use those funds to do basically two things, mostly to pay our benefits and health insurance, which is quite a sizable amount, and also to pay our administrative expenses of the office. So if we go to the next slide. So as Benji mentioned earlier, the budget is divided into 4 main categories, and those categories are personnel services, non-personnel equipment, professional services, and medical services. For the personnel services, we use a 50-50 split based on the budget office labour reports, except for our investment staff. For the investment staff, we split basically on market value between the two, which is about 60-40. But for the rest of the expenses, it's 50-50. So only the personnel for investment staff is split at that 40-60. The non-personnel equipment is basically the overhead costs, and that includes rent, supplies, equipment. It excludes professional services as that's a category of its own. Professional services category is basically your actuarial, legal, IT and accounting, and other professional consulting services as needed. And then lastly, we've got the medical services, and that's the costs associated basically with the disability retirement process. So if we go to our next slide, this graph is showing you actual, forecast, and proposed sources of funds over the last 4 years. And as you can see for 2024-25, in this graph, the investment income for the forecast and proposed is calculated based on the assumed rate of return, based on the asset allocation if we do return those 6 5/8. So we would produce 286 million approximately in investment income. And also, based on the actuarial valuations that you approved from Chiron for the 23-24 year, we expect about $46.4 for participant contributions and about 240.6 million in city contributions. Now, going to our next slide. So this is showing the same number for the uses of funds. We have the actual numbers for the 4 years, forecast for the current year 2024, and proposed for the coming year. As you can see, the administrative expenses is the smallest amount at 8.2, health insurance at 30, and but the bulk is actually going to the pension benefits of 301.3 million. So now, if we go to our next slide, this is showing the proposed budget. So the proposed budget is about $8.2 million, and that's comprised of 5.6 of personnel services, 867,000 for non-personnel equipment, 1.29 million for professional services, and 360 for medical services. If you look at the total request, 8.2 million, that's about 11.12 increase from the forecast for the current year. So we are forecasting the current year to be about 7.39. Now, if you look at the 23-24 adopted / modified column, that's column B, you'll see two figures listed at the bottom. There's the 6.914 million and the 7.614, the modified amount being the amount that you just approved in that prior budget item. The next slides to follow will provide some details on those numbers. So if we go to this next slide, in terms of personnel services, the proposed budget of 5.698 million, currently we have 43 positions for the proposed. It assumes a position count of 46. So we're working through the city process. We're working with the city's mayor, or the mayor's office. As of today, we haven't had any indication yet as to if these proposed positions will get approved. And we'll certainly come back to you, board, if we need to. We would expect to hear in the next 4 weeks or so if those will be approved. So for today, we're proposing to you a budget amount that does assume that 3 positions will be approved.
Barbara, can I make a comment?
Please do.
We are considered under the city structure an appointee office. So the city have departments like the airport and public works and all the departments, and then they have appointees, which are the city auditor, the city attorney's office, the city clerk, the auditor of the police operations, and the retirement office. And while most of the city works through the city manager's office and the city manager for the budget, the appointees, I guess, they go through the mayor's office. At least our office does. Now, the reason I asked Barbara to let me speak is because this is an issue that I have worked with the city over the years, worked through it. I have always understood that the reason this office is in here is because the city, the employer, decided to provide a benefit to their employees. So that's why we exist. I'm also well aware that we come before you and request for you board approval on this, which includes personnel, which includes positions. And over the years, when we go to the city, through the city mayor's office, they have at times supported our request and at times they have said no. And we have pushed back and, going back and forth and maybe get one of the two or two of the three. But I'm letting you know because we don't know what the city is going to respond this year. I'm very confident they're going to approve one or two. I'm not sure they're going to approve all 3. I even hesitate to use the word approve because I don't think there's anyone at the city that have a better idea of what we need than us that work at the office. But I have made it my job to make sure that I continue working with the boards and the city mayor's office and the city administration, and we continue moving forward, understanding that we're part of a bigger institution, which is the city. Having said that, we are a separate entity. I'm only saying this because there's going to come a time where there is not going to be an agreement between our office and the mayor's office, and that's going to be a standstill. And at that point, you boys are going to have to decide how we're going to move forward. Meaning, the mayor may not approve the positions, but we are going to move forward with it. And you're going to say, we don't care, we're going to move forward. You're going to present that to the city council. City council may not approve it. And then you're going to have to make a decision on what you want to do next. Mm-hmm. I'm not suggesting that it's this year. We'll see how the discussion goes. The city is actually going through the budget process right now, so I really have no idea what they're going to respond. But again, I just wanted to give you that background. I'm not saying this to suggest that there's anything that's going to happen or anything that we need to do. I'm just giving you some background so that you understand that sometime in the future, we don't always agree, and there are years that we have decided to move forward without pushing the envelope, but there's going to come a time at some point that we're going to decide we cannot sit and decide that it's okay, we don't need the position. We need it regardless of how the mayor office feels about it. So again, I'm not suggesting this is this year, but I wanted to give you that background and understanding. But in most cases, except for the year that we actually returned about 27%, which we got approved all 3 positions, there's always a back and forth, and we don't always get all the approvals that we request. I think the office, the staff has done an excellent job this year providing rationale behind the request. One of those positions is the position related to the procurement and everything else, and all these audit findings and the discussion with the city. So I'm confident that position will be approved, and I'm hoping that certainly the next 2 also are approved. But if not, at least the health benefit analysis is something that we feel very strongly about. So with that context, I wanted you to understand that, and I want to turn it over to Barbara.
Yeah, so as I said, the budget that we're presenting to you this morning is assuming, or this afternoon, is assuming the 3 positions will be approved. And those additional positions are the senior analyst, compliance officer in accounting for the procurement and contracting, the Medicare analyst and benefits, and a senior office specialist for our frontline customer service in benefits. And that would increase our positions from 43 positions to 46 for the office. And again, those would be split half and half with both plans. So it comes out to 23 positions per plan.
Just so that I'm clear, Barbara, I know Benji alluded that at the beginning. The half of a position that we agreed to fund through the IT is not here because it's not the position is in IT.
Exactly.
But the budget does include, I just want the board to understand, the budget does include the funds to fund half of the cost of the benefits and salary of that position.
Correct. That's exactly right, yes. At the bottom of this slide, you'll see the proposals and what they include. So there's the 3 additions. There's the funding for that 50% cybersecurity IT person. And then there's another few, we think we have a retirement in our benefits, 4 months for the benefit analyst. We have a CEO that has wants to retire. And so we've got a 1 month overlap built into the budget as well for that. And we've got 12 months of an admin staff specialist in the proposed number.
Barbara, I assume overstrength means overlap, so you'll have doubling?
That's right, yes.
Okay, and what is the reason for the 1 year of the admin staff specialist on the doubling up?
That is our group right behind us that support you boards. And for the past few, last year we asked for it and we did get an overstrength. We are asking for an additional, and that is to support you boards. You've had extra out of this procurement contracting. There's been a lot more meetings, and so they need to spend a little bit more time preparing for meetings and hosting meetings. So that's to fund that.
Oh, I see. So it's not a permanent full-time role?
It has not been made permanent or full-time yet.
And then one last question. Do you anticipate hiring challenges for the 3 open positions, or is it going to be similar to the experience we've had in the past with hiring?
For right now, our compliance officer, senior analyst, that may be challenging. We're going to have to, for our Medicare analyst, we actually have someone in the office working in that role at the minute. It was funded last year, but only for 1 year, and so we'd like to make that a permanent ongoing position. And then for the senior office, we funded that through a temp position, and there is someone working in the office in that role.
Hmm.
So for those two, Medicare analyst and senior, I wouldn't anticipate it being too challenging for the recruitment for the permanent, but the compliance senior analyst possibly.
Okay, thank you.
So if we go to the next slide here, and that is showing you the organizational chart for 24 fiscal year, or 24-25 fiscal year. And you'll see blue, and you'll see the word proposed. Those are those three proposed newly positions. As I mentioned, one of them is in our accounting, and then two of them is in our benefits group. And I would note Sandra, our benefits manager, she joined us back in August 2021, and she came to us from another department within the city, and she's worked for the city for very many years. And when she looked at the ORS operations, she determined that we were wholly understaffed, and especially how complex our benefit plans have become. And she's worked extremely hard to address that issue. So last year we did add one new position, but as I say, we're asking for two more this year in the benefits division and one in the accounting group. So going to our next slide, this is the explanation for the non-personnel equipment. Last year you adopted 859,000, and we're asking for a little more this year at 867,000, an overall increase of 0.93. As you can see, fairly consistent from last year, and that includes CPI increases for all other areas, which include rent and everything else. So if we go now to our next slide, here we have the detail for our non-personnel equipment, and the largest costs here are the rent and the fiduciary and commercial liability insurance. We have IT hardware and so on and so forth, and that adds up to about 867,000. A slight increase in the travel budget this year from 30,000 to 35,000, as we're seeing, trustees and staff traveling a little bit more to their educational conferences and roundtables and due diligence. So going now to our next slide, this one is for our professional services. This is the category that you actually just modified for this year. That's why you'll see in column B the two numbers, the modified or the adopted and then the modified. So you'll see the adopted was 903, but now the modified is 1,403. But we're forecasting at 1,351,000. So when you compare the adopted to the proposed, it is a 43.52 increase. However, comparing it to the modified, it's a 7.63 decrease. And when you compare the proposed to the forecast, it's a 4.1 decrease. So the rationale behind that is that there has been work associated with this year that's quite unique, and we wouldn't expect that to be ongoing at the level that it has been, we experienced in 2023 anyway. So now if we go to our next slide, this slide provides you some detail on what makes up the 1.296 million for the professional services. The bulk of that number is legal, so mostly your general fiduciary counsel, Reed Smith, and includes Ice Miller, your tax counsel, and Saltzman and Johnson for disability counsel, and that accounts for the 681,000. Your actuary and Chiron, they do perform 2 valuations a year for police and fire system, and they do further work on benefit calculations, including 415. So as well as other miscellaneous consultations, and that comes to 271,000. For the temporary agency, this is where we have temporary staff either to fill vacancies or supplement staff for special projects, including open enrollment. That comes in at
$544,500.
No question
Your
on that?
audit,
Just a question on temp agency. So this budget item, if you were to fill those, like, or have the opportunity to hire the 3 people you wanted, then wouldn't this go down?
sorry, I
next year?
didn't hear what you said.
No, I'm just asking about this temp agency line item. If you were able to fill those positions that you requested for next year, would this line item, the total amount, go down?
Well, the budget will not
Yeah.
go down, but the amount actually spent may, yeah. So next year, we might not spend what you've budgeted. And as Benji mentioned earlier, we'll budget a number, but that's just a budget request. It's not actually what we may spend.
Okay, thank you.
So, so now going on to your audit, which is the financial audit, that's at 92,000. And there's other professional services that we work with for retiree searches, or Cortex for your governance services, and board communication consultants who help with the newsletter. And finally, the pension administration system at 24,000 for web changes, disaster recovery, change requests, and hosting, etc.
So this doesn't include the investment consultants, Makita. Where does that go?
No, not investment.
So those are investment expenses,
Okay.
and so investment expenses per California law are really deducted from the earnings of the plan.
Okay.
So that's why they're not really part of the budget.
Understood.
So if we go now to the next slide, this fourth main bucket is medical services, and this is for the cost associated with the disability applications. And that comes in at the 360,000, and that's, we're not projecting any more or less than we have in prior years. So moving to the next slide then, this provides you, board, some data that allows you to compare our budget requests with similarly sized peer plans throughout the state of California. This slide is showing the personnel expenses in basis points. And keep in mind, like for San Jose, we have one office and one set of staff, but that set of staff serves 2 boards and 2 plans. And so this is not typical. I've heard Roberto mention in prior years that it's actually the only plan he knows of that has this structure. So, and that does impact some of the costs associated. The other main thing, we are in the Bay Area, and so costs may look higher than other agencies across the state because of the costs associated with the Bay Area. And unlike we have a large number of in-house investment staff supporting the board's investment objectives, again, that's not necessarily something that you'll see in other agencies, but it is a strategic decision of you boards, and so this has an impact as well. So this is showing the personnel expenses in basis points of market value, and you'll see in red, that's the federated system. The O, the green O, is police and fire, and the blue, well, it's more purple actually. The blue or purple plus sign represents the combined amount. So the next slide, this is again personnel, but instead of basis points, it's showing us in dollar figures. And you'll just see from where you're seeing the marks, we're very much in the mix. We're not really an outlier in any terms.
Can I ask why the delta from 21-22 to 22-23 was so much higher for PNF versus federated?
Benji, can you comment on why the figures came in?
I'm going to have to look into that because I don't know.
Okay. It's a 1.1 million for plus 300,000 for veteran.
Make sure it's a decrease. Is it down
Oh, it went down?
for them?
Yeah, it went down for them, actually, yeah, okay.
Which are we looking at, 16?
We're looking at
16,
line,
yeah.
Yeah. That's a good, well, part of it is the asset side, right? So 60% versus 40%, so whatever increases are gonna be out of a larger figure, that's gonna increase the amount. That in itself doesn't explain the decrease.
Yeah.
So that's a good
It doesn't-
question.
that
Do you
doesn't
see
show
what,
the
Benji,
decrease.
you see what they're referring to from 3.6?
I do.
Yeah. So we have to check on that, thank you.
Yeah, I'll have to check on
Maybe
that.
get some
It
money
might
back
have, it
from
might be a typo, but I'm sharing my screen, so I can't.
Visibility? Well, I think what happened is, we didn't want to say this publicly, but I think the investment staff actually works harder for you than for the other board. So we have to take some money away from the other side and put it on Police and Fire. But let's just leave that on the side and check it. That
They
that's
produce
okay.
the results, though.
Yeah, that's right.
You have to, we're more expensive.
I don't know, Jay, is that one?
We work hard for everybody.
Oh, okay, good, all right.
Elect him.
No, thank you, we'll look into it, that's a fair question.
And then she's going to go back to driving our presentation, and she's going to go to the next slide. And that's the administrative costs. Again, the next two slides are going to be showing you the administrative cost comparisons. This first one in basis points, and the next one in monetary terms. And again, these are just for your own information to give you some sense of, is the budget being proposed in the ballpark of other agencies, other peers across our state.
I guess if the other slide made you feel bad, this one is going to make you feel better. But of course, you have a larger asset size, so those you're going to take advantage of that for the basis points.
The administrative cost includes the personnel cost, right?
Yes, yes. The first couple are personal only. This is the full administrative cost.
Mm-hmm.
So without the investment consultants, we're at about 15, 16 basis point, 13, 14 for police and fire.
I'm sorry, I lost.
Without the investment consultant, investment expenses, it sounds like we're 13 to 15, which just seems okay, I suppose.
Yes, okay, yes. But this is 13, 15, this is for the whole administration. So it does include the personnel costs for the investment staff, but not the investment expenses,
Mhm.
correct.
And then going to the next slide, very similar information for you, but that's membership count, and then the final one is a head count comparison to other agencies. And that concludes the presentation. I'm happy to address any questions and staff seeking approval for the boards for the proposed budget for fiscal year 24-25.
I do have a question back to personnel services analysis page where I guess there's, my initial reaction is that obviously that's the biggest increase of all the different line items, and that's probably because of the additional hires that we want to include in there.
Mm-hmm.
If we exclude those additional hires, what would that number look like? Would it still be an increase, and how much? Do you know? I just want to get a sense.
It would still be an increase because the budget, well, the personnel services, the numbers are driven by the budget office's labor report. And so we base it off of that, and they include what they think the next like increase, performance increase, or city increases for everyone. So it would definitely be an increase, but I would expect it to be around 5% only, because that's I think that's what is in next year's MOUs.
Okay, 5% seems a lot more reasonable
Yeah.
than these numbers on the surface, so that makes up the difference. Okay.
I'm assuming you're only gonna cover this. I know there's another document in here. The proposed budget?
No, that's it. That's the budget presentation.
Okay.
It's D, yeah.
Okay, so I guess we're just accepting this,
It's
Approving it?
Action item, I think.
approving it.
It's an action item. If it's D, motion to approve.
Second.
Got a motion from Dick and a second from Sunita. Any further discussion? All those in favor?
Aye.
Aye.
Opposed?
Very thorough presentation, thanks.
Yeah, thank you.
Okay, so I think we're going to G. 4G.
Yes, so I'll let, I know Meta has some comments on that, but I wanted to kick it off. You heard, Councilmember Foley, in her comments, she indicated the city went back to, in-person meetings and, members of the public, and quite honestly, staff or city council members cannot attend, remotely anymore. They have to be in person at the meeting. They cannot be on Zoom. They as in the city send out through the city clerk to all departments and all the boards and commissions this step and when it was going to take effect. It is, I understand that this approach of requiring attendance in person is temporarily through June. As you know, the city takes the month of July off from public meetings. They come back in August. And they send that memo to everyone, including, and that was to be implemented by all boards and commissions. I felt that, and the main reason for their request or for their change is, I think you heard Councilmember Foley had to do, is that the city had issues on their council meetings with hate speeches on Zoom. They had quite a few experiences of those, and they wanted to cut that off for now. So I actually, when the direction came down, I actually wrote an email to the mayor's office, and I copied both of our city council members for this board and the fifth board, and both boards chairs, Battle for Police and Fire and Spencer for Federated, explaining the rationale for my request that the boards will be allowed to continue having meetings remotely and allow presentations, attendance by members through Zoom. I was very clear that that was just my recommendation, that I couldn't speak for the board have to make the determination themselves. But I provided a couple of rationales. The first one was that we haven't really suffered the same kind of situation the council has in terms of hate speech and issues at the meetings. Also, I mentioned that unlike the city, who obviously have meetings in San Jose, our members come from everywhere. Sure, the bulk of them are in the proximity of San Jose, but many of them live outside the state, and quite a few of them live outside the country. And this was a very efficient way for them to attend meetings. I also mentioned, and you saw that this morning, that not only for the boards, but especially for committee meetings, it is very efficient to allow for participation, especially by consultants, remotely through Zoom. So because of those two issues, I strongly recommended that the boards be allowed, like an exception, and allowed to continue making or having these meetings through Zoom. But again, I can't emphasize enough that I was very clear speaking the CEO from the office, and that the items were going to be addressed to the specific boards for the boards to decide. This issue was actually addressed at the federal board at the last meeting, and they elected to continue the meetings through Zoom and allow participation remotely through Zoom. and now this item is before you. Now, having said that, I don't know if Meta has some prepared comments as well.
Sure, I just have a very few comments and I'll be brief. So legally under the Brown Act, it allows trustees to attend virtually under two large exceptions, one of them being the traditional teleconferencing rules under the traditional Brown Act rules. And the second is being AB 2449, which allows trustees to attend virtually for emergency or just cause as defined under the statute. Child care issues, medical, COVID, for example, allows the trustees to attend virtually. Now, under the Brown Act, however, if a trustee attends virtually, then that agency must allow the public to attend virtually. And so with the City Council's rule as stated in the memorandum, it will prohibit trustees from attending virtually because they are trying to tamp down on hate speech that are appearing virtually in public comments. And so the decision point before this board today is whether or not they would follow the city's memorandum, essentially prohibiting trustees from attending virtually for the period of now up until, I believe the directive ends in July. So from now until July, not allowing any trustees to attend virtually is essentially the decision point. Do you want to follow the city on that point, or would you want to allow to go under the traditional Brown Act, which the law requires? The city's directive is much more restrictive, obviously, than the state law provides, and so that's why it's up to the board to exercise its discretion to determine whether or not they want to follow that directive.
Mr. Chair, may I?
So would that be a motion to approve as under the Brown Act?
So the way we did it with Federated was that they took a motion to decline to follow the
city's memorandum.
If I may, I'd just like to point out this would place an absurd burden on our retirees, as Roberta pointed out, especially for our disability committee that Dick and I sit on, where they almost exclusively attend virtually, either due to medical conditions they're working with and hard to get around, or because they actually live outside the state, as Roberta pointed out. With that in mind, if there's no other discussion, I'd like to make the motion to not follow what the city has proposed and to continue the way we've been doing it.
Mr. Chair, I'll second that based on what Dave said is correct.
I have a motion from Wilson, second from Dick. Any further discussion? All those in favor?
Aye. Aye.
Opposed? Okay.
Thank you. Mr. Chair, I haven't heard back from the mayor's office yet, so they haven't provided. They did thank me for the input, but they haven't heard back. And I do wanted to, again, good catch. I just received an email from staff indicating that that slide is incorrect, and you'll be happy to know that the actual number for Federated went up from 3.6 to 3.9 instead of going down to 3.3. And guess what? Police and fire went down from 5 to 4.4.
You know how lawyers do when you save money, they get part of it.
That's right, and you will get from the bottom of our hearts and staff a big thank you for fixing that slide and keeping us honest. So thank you very much.
Mr. Chair, may I make a recommendation that based on what Trustee Wilson said, that our liaison be informed at the same time the mayor is, so we keep a consistency.
Yep. I'm sure they'll probably hear it at the same meeting. Okay, moving on to 4H. Discussion and action on amendments to Police and Fire Board Charter to reflect changes from Joint Personnel Committee regarding CEO, CIO employment issues.
So previously, when we presented to this board at the last meeting, the JPC charter changes to handle how to deal with disagreements between the two boards on personnel issues related to the CEO and CIO. So if you may recall that came before the board at the last meeting. Now, because the process that the board and JPC have adopted involves a lot of back and forth between the two bodies, one the committee and two the boards, it required a change to the board's charter as well to reflect those changes. And so essentially what we did was update the board's charters to reflect the same process stated in the JPC charter. Thank you.
Okay, so this is a discussion and action. So I will entertain a motion.
This is different from, I mean, is there more in this than we saw last time?
No, so the red line changes are the exact same as what was in the JPC charter's red line changes. The
Okay.
balance of the charter is what the existing charter is.
Oh,
The only
thank you.
difference between this charter and the JPC charter are the paragraph numbers, because the paragraph numbers are different, and also certain bodies, instead of referring to the boards plural, we said the board here.
Got it, thank you.
Okay, I'll move a motion to adopt
Second.
the changes.
Got a motion from Eswar and a second from Dick. Any further discussion? All those in favor?
Aye.
Aye.
Opposed? Okay. All right, we'll be moving on to number 5, which is retirements. We have Maulio Gonzalez, firefighter, fire department, effective January 28th, 2024, 21.97 years of service. We got Anthony Mata, chief of police, police department, effective March 30th, 2024, 27.57 years of service.
Motion to approve.
And a motion from Dick,
Second.
second from Wilson. All those in favor?
Aye.
Opposed? Any words?
Dave?
Yeah, just wish Tony the best of luck. We started this venture here in San Jose, well, evidently 27.57 years ago as we were in the same academy. He's moving on to bigger and better things, or maybe not bigger and better, but he's going over to Santa Clara Deputy Investigator's Office as their chief of police. Deputy Chief Investigator, I guess would be. So, best of luck to him out there.
Yeah, Mr. Chair, to the service retirements, the best. I hope you enjoy your retirement, and especially the Chief Mata. I had the opportunity to meet with him on numerous times for the community, and he was wonderful. I hope it sends a message to our council. Keep it inside. San Jose has experienced people. Our police officers want them, and they've done a great job. Thank you.
Thank you. All right, we have defer vested. Cristobal Dominguez, police lieutenant, police department, effective March 11th, 2024, 26.88 years of service. I have a motion.
So moved.
A motion, Dick.
Second.
Second, Wilson. All those in favor?
Aye.
Aye.
Opposed? Okay. Move on to death and survivorship notifications. Notification of the death of Anthony E. Beckwith, police officer, retired September 15th, 2000, died December 11th, 2023. Survivorship benefits to Cheryl Beckwith, spouse. Notification of the death of Merlin W. Dyball,
Dieball, yep.
fire engineer, retired February 7th, 2005, died December 1st, 2023. No survivorship benefits. Notification of the death of Lawrence Linden, police officer, retired March 4th, 1987, died January 22, 2024. Survivorship benefits to Ruth Linden, spouse. Notification of the death of Bill Tate, police officer, retired January 28, 2004, died January 14th, 2024. Survivorship benefits to Judith Tate, spouse. I have a moment of silence. Okay. We're now moving on to committee reports. First one is investment committee.
So investment committee, we did have a meeting. We discussed the two items we discussed here today also, which were the strategic asset allocation and the pre-funding.
Capital market.
What is it?
Capital market expectations.
Yeah, capital market. What is it?
You said strategic asset.
Oh.
It's in the ballpark.
Yeah.
Okay, I believe we have to receive and file the minutes. 7-2, audit risk committee.
Yeah, I think I'll provide it this time, and then from next time, Howard will.
Thank you, Sunita.
Next page. Guess it was a, not as long as the October meeting, where we set a record, but a fair number of issues were rediscussed. I don't know, I guess, do we do minutes before we talk about 7CDE, or?
You can accept the minutes now.
Okay, we can accept and receive, or received and file the minutes. Go ahead.
On 7.2C and D, these were items from the audit procurement and contract oversight report from May. We had discussed it in October, and there were some changes that were proposed based on, information we had received. We had another discussion on new information we had received, and management has appropriately responded to all of them. I think this is really ready to move on for sure. So I believe there's an action item, Chair, on both.
So these two need to have two separate actions.
Yeah, so the recommendation from the audit committee is to accept the response on 7.2C.
I'll make the motion to, for the full board to accept the management's response as amended in 7.2C.
Second.
Okay, we have a motion from Wilson, second from Dick. All those in favor?
Aye.
Opposed? Okay.
Similarly, the audit committee recommends accepting 7.2D. This is, again, one of the findings from the procurement contract oversight report. So management response was recommended, is being recommended to be accepted.
I will make the same motion for 7.2D to accept the management's amended response, this one for finding 3.
Second.
Got a motion from Wilson, second from Dick. All those in favor?
Aye.
Aye. Opposed? E.
On 7.2E, this was the item where investment returns were erroneously underreported for separate accounts. You might recollect that MGO did an audit on agreed upon procedures, and the returns were restated in our ACFR. And I believe, I don't know, Roberto, do you want to?
So I think the direction was, we will be drafting a letter, which we're hoping to go out next week. And originally, the recommendation was for the letter to come from the board chairs. I think the committee indicated they'd rather have the letter come from the CEO, but also have the signature from both board chairs. Is that correct?
That's correct.
Yes.
And this is because the custodial bank wants, communication from the highest level of authority for them to restate returns going back in time.
Yes.
So there's an action.
Do we have a motion?
Make the motion to, for the CEO and ORS to draft the letter and have it co-signed by both boards, directed to the Bank of New York, our custodial bank.
Second.
Motion Wilson, second from Dick. All those in favor?
Aye.
Opposed? Okay. F.
On F, this was an action item we had discovered in in the charter itself, we have a provision for an annual audit plan to be presented for the approvals of the audit committees. And we really hadn't been following that as much. It was sort of more ad hoc, the scope of the audit. We wanted to memorialize that and have the internal auditor present to the joint audit committee for approval, that he or she would work with the CEO and the chairs before they come in front of the audit committee to approve an annual plan starting in fiscal 24-25 onward. I don't know if I missed anything. Yeah, okay.
No, I think that was it. It was mainly going back to doing it yearly rather than this 5-year plan that we originally had adopted. That way we had a little more control over the internal audits and what we need to have direction on a yearly basis.
Yeah, I mean, the 5-year plan isn't being done away with, but it's it provides the backdrop, but the annual plan will be much more, the audit committee chairs can direct where or the audit committees can direct where the prioritization is for every year. I think that was sort of that was the purpose, so action. So we recommend to the board to adopt this annual audit plan.
Okay, we have a motion.
So moved.
And a motion from Dick.
I'll second.
I'm sorry, who was that?
You
Second from Ezra. All those in favor?
Aye.
Aye.
All those opposed?
Have we ran out of motions yet?
It was a long meeting.
Yeah, we did.
It was a long meeting.
Yeah. and
Update from the city auditor.
Yeah, so this was, I guess we thought the city auditor's work for the first phase of this audit was complete, which it was. And there was one item we understand from Joe that was remaining in the mayor's letter, which was a testing of ORS's procurement against city policies. We had some discussion around this because we already have policies that are being drafted by the governance committee and with our council, and we had a fairly sort of pushback discussion with what is the purpose of this, but I think we all came to the conclusion that this was a benchmarking exercise to see if there were gaps that needed to be addressed between ORS's policy and the city's procurement policy. So just want to make sure the board had visibility into this. There's going to be a special audit committee meeting in April after the report comes out, but before he goes in front of the city council.
Yes, have we pinned down, I'm just asking staff now, Trustee Ganapati, have we pinned down the day for the joint audit committee? What is that day? No, April 19th is the council meeting.
I have 11.
I'm sorry.
Yeah.
11,
Yeah,
okay.
it was pinned down, yes.
Yeah, thank you.
So we will hear more about that, but I don't think the full board will hear about it till, I guess, after the city council meeting. So just a heads up. It is just for full visibility, it is a little confusing because there is the procurement policies, there's the Muni code changes, and there is the council and governance committee working on new policies. And so I don't know what the testing is going to show us, but time will tell, I guess. Any questions on that? On H, I just transitioned responsibilities to Howard as new audit chair from the next meeting. I recognized that we had made a lot of progress this year. We had addressed Harvey had helped us address the investment fee piece in ACFR, and Maytag has helping us address the procurement gaps. And we took action on all the findings, or we made management responsible for taking actions. So, it was a very busy year, and I think we completed most of what's there to be done. So it's a good time for a new chair to step in and address the next set of issues.
Okay, thank you. Governance Committee, we last met on January 29th. Our next meeting is after this meeting, and there is no update. Disability.
Yes, we'll meet on the 11th or 10 o'clock at the retirement office. We also have the minutes there. Also, it says discussion and action for approval of the disability retirement application of rules and procedures.
So if I may just jump in here. So as a part of our governance improvement project, what we have here as the backup material is memorializing our disability retirement application process and procedures in writing for the benefit of the staff, the board, committee members, and future generations. There are 3 features in the policy at a high level. And the ones that are being added are as follows. 1, what to do with the member who's filed an application and has become non-responsive. What the policy provides is that ORS would contact the member twice per communication method provided on the application submitted for disability within a 90-day window. And once that has occurred, or that phase has elapsed, that it would move on to the next stage of the application process. So we'd go from the filing, then to the IME, then from the IME to the before the committee, and then before the committee, before the board. And so those are the 4 steps of the process. And if a member becomes responsive in any one of those processes, that we would re-engage the member at that time. But the whole idea and spirit of the non-responsive rule is to keep these disability applications moving to avoid any backlog. Number 2 is to add a checklist cover sheet on the elements of whether or not the disability has been met. This is a practice that police and fire adopted, and so we're just memorializing that into the actual policy so that the future generations will continue with that practice. And lastly, the policy gives the committee the sole judgment to make exceptions for good cause. So say a member fails to either submit an application as compliant with the code, or as, for example, not responding or failing to submit certain documentations along the way due to a good cause as defined in the policy, we have the sole judgment to make an exception. Now, at our disability, just for full disclosure for the board, at the disability committee, the committee approved the policy. However, also advised staff to reach out to all the stakeholders. So reach out to all the common disability attorneys that represent the membership. And we've also reached out to the union retiree president as well for his comments on the policy. And as far as I understand from Ms. Castellano, we have not received any substantive responses to the policy. And so we've put them on notice. We haven't received anything. And now the policy is before the board for adoption.
Okay, I believe this is a discussion and action item.
Motion to approve, Mr. Chair.
Motion from Dick,
Second.
second from Wilson. All those in favor?
Aye.
Opposed? Okay.
And Mr. Chair, just one more added thing is that our medical panel, Russ Raqueta, is facing some medical issues. Along with Trustee Wilson, we've given 100% working whatever we can do, and our prayers and thoughts are with him.
Absolutely. Joint Personnel Committee.
No meeting last month. We have one coming up in a couple of weeks as we keep working on the CEO hire.
Okay, and just in case I didn't say it, because I didn't check it, receive and file the minutes from Disability Committee. Any proposed agenda items? Hearing none, this meeting is adjourned. We'll reconvene in about 8-10 minutes, give staff time to do whatever they gotta do over here.